Okay, so we have the 10K open for Fastly. Let's read this and understand this company a little bit. Organizations around the world are more dependent on the quality of digital experiences they provide than ever before. We deliver an edge cloud platform capable of delivering fast, safe, and engaging digital experiences. By focusing holistically on the edge cloud, from developer inspiration to end user experience, we have the opportunity to differentiate with our global footprint, dynamic infrastructure, and security. So I think we get what they do. Have a bunch of good metrics here. They're saying legacy CDNs don't keep up. WebAssembly, oh cool. WASM compilers, I think a lot of these bigger internet companies, they might do a deal with them. Legacy CDNs like Akamai and 𝐤𝐵, Akamai, AWS Cloudflare, F5, and Thales. Point CDN players like Bunny CDN. I've never heard of Bunny CDNs. For anybody who doesn't know, a CDN is basically a company that has servers around the country, and those servers, in essence, just cache popular sort of scripts and other data. So when a user hits the local server, they don't have to hop all the way to some other server to get the same data. AWS Virginia, you don't have to send the user from California all the way to AWS Virginia. Top 10 customers. They have a lot of media and entertainment customers, so that's interesting. Maybe Disney or someone like that. But we're curious, how do they price their product? What do they do differently from Akamai? All that stuff really does take a lot of time, so I can't do it here without boring you guys. But that stuff is super important. It's like, I want to make sure that you understand that, I'm sort of investing or recommending or trading with one hand tied behind my back because I don't exactly know too much about the company. Now, when I look at a pharma company, it's really easy for me. Okay, so their average enterprise customer is doing almost $1 million. The retention rate is enormous, 99% retention. Oh, they changed their methodology. Wonderful. How do you change the definition of a customer? Dollar-based net expansion, net retention rate, LTM net retention rate. I'm not going to include those. It's getting a little ridiculous. It's pretty straightforward business. I think they were growing faster. Growth has slowed fairly dramatically for them. I wonder what Akamai's valuation is. Because these guys are 2x sales. Margins aren't terrible. They're not software margins. They're more like cloud computing margins. But that makes sense because they just buy a bunch of servers and plop them down across the country. Why is that, Mr. Johns? In their own 10K, they compare themselves to Akamai. But as you guys can see, they were growing 17% and 22%. And now I think they're quite a bit slower. But they're both CDNs. CDN is CDN, right? But it's still a CDN. At least the company says it's better, but Akamai's not exactly, nobody's saying Akamai's dead. We should look at Akamai after this. Yeah, the slowdown in revenue is a little alarming. But let's read their press release. I'm sure they reported Q4, so maybe Q4 will give us some clues. But here's the most important thing, right? Which is, what are cash flows for the last several years? And a growing company it's okay if they're unprofitable, right? But they were pretty unprofitable. I think this year is the first year where they might show some more progress there. And if they can compete with Akamai, then great. All right, so let's look for the quarterly report. It should be right here somewhere in Business Wire. Almost all the press releases are on Business Wire or PR Newswire. So here's, do give guidance. They did 140,579. That's lower than I thought they'd do. Wow. So growth is now 2%. Hard to be too excited about that. If they're the new CDN, I don't want the old CDN. Cloudflare's growing a lot faster than them. So I don't know if I'd compare them to Cloudflare. Oh man, look at the guidance for next quarter. Whoa! 136 to 140. Oh man. You guys see this? From 20% growth to 14 to 8 to 7 to 2 and 3. Bro, there's food and beverage companies with more growth than this. Come on, bro. Come on, bro. D-Wave's growing faster than this. This is an edge CDN tech company. Come on, man. Do something. What's the guidance for the full year? Yeah, they're saying they'll grow a little better than that. They're saying they'll grow like 6-7% for the full year, but for the first quarter, they're going to grow 3%. So that's what 𝐼𝐴𝐼𝐿 is doing. They're saying, well, for the whole year, everything's great, but next quarter, don't worry, our sales reps will get it in gear in Q2 and Q3. It's just going to be atrocious for the first 3 months. Oh, man. I don't know. In software, you have to grow. You really just have to grow. There's no choice. All right, so conceivably, cash flow for this year was 5? I need it for the year. Okay, there it is. Okay, cash flow for the year was 16. Not bad. But CapEx was 10, which leaves us with 6 million free cash flow. And it's going in the right direction, but without growth, it's kind of hard to grow that. Even if they make their 7%, which seems like a stretch given Q2 is 3% or Q1 is 3%, it's kind of hard to grow cash flow too much. Yeah, I would avoid this one. It could even be a short, arguably, unless they have like a master plan for getting growth back, which I'm sure they do, or there's some really good explanation why growth is temporarily slowed. Yeah, they must have something going on that I don't know. So yeah, we don't do indicators yet, but we will. We will have indicators soon. We know they're important to a lot of traders, so we're working on that. We're basically going to have just trading view 3 or whatever it is. But yeah, I want to look at Akamai real quick just because I want to see how they're valued and sort of see if I'm just shorting more Rigetti and more 𝐼𝐿. I think as long as NVIDIA's down, it's kind of tough to own any stock because like NVIDIA's doing fine. I don't know. I guess NVIDIA's in a bit of a special category because they're undergoing like a fairly unique situation. Yeah, I don't know if the FTC will let Shopify buy anyone like that. Acquisitions, I mean, most of these tech companies don't want to do acquisitions anyway because it's in pharma, you kind of have to do them because you don't get growth anywhere else. But in tech, acquisitions are pretty distracting. I wouldn't want to do an acquisition in tech unless you're getting something really special. What do you mean? Have you shared what my shorts are? I'm short 𝐼𝐿, Rigetti, and D-Wave. No, tech companies don't live off acquisitions. Apple hasn't made a substantial acquisition in its whole corporate life. Microsoft either. It's funny, Microsoft's biggest acquisition ever before Activision was like $15 billion. It's a $3 trillion company. They did it all internally. They didn't have to buy anyone to make Xbox. They didn't have to buy anyone to make AWS. I'm sorry, Azure. Meta is different. Yeah, Meta's different. Meta's very acquisitive. But Apple and Microsoft are very... Tesla, very hands-off. Tesla's never really done anything other than Solar City, which was just sort of a bailout. So a lot of these companies just want to stay vertically integrated. You know, Salesforce is different. You know, some Oracle's very acquisitive. You know, everyone has a different philosophy, but Google, you know, YouTube was $1 billion and it was a really long time ago. Other than that, I'm not sure what else is there to Google. GitHub was a really small deal. Yeah, those were all small deals. YouTube was the only game changer, but YouTube sort of, the thing about YouTube is they made YouTube work. I don't think it was YouTube that made YouTube work. They nurtured YouTube and grew it. Let me just glance at Akamai. Facebook's deals have been the best deals in history. But, you know, the very biggest, the very, 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 very biggest companies, the top 4 companies, Amazon, Google, Alphabet, and Apple, there's really no special acquisition between them. That was a really big deal. There have been a lot of good deals in pharma. Probably Johnson & Johnson's acquisition of Centocor. That might have been the GOAT deal, but there's others. Royalty Pharma did a lot of GOAT deals. So at least back in Q1, they had a slight net debt position. Yeah, there's like 5 or 6 royalty companies at least in pharma off the top of my head. Yeah, you're thinking of DeepMind, not DeepSeek, but I don't think much of these companies would have changed Google. A lot of them were stuff they already tucked in to the company, or they would have tucked into the company, you know, building it versus buying it. It's sort of like tail wagging the dog. I mean, Google search was the most important thing, and they didn't buy anyone for mail. They didn't buy anyone for maps. They didn't, you know, it was just sort of all organic. I thought they made maps themselves. And I'll go back and I'll talk to some of the people and see what the real story was. The question was did that acquisition completely enable it, or was it? What exactly was the story? There's guys like Paul Buchheit and Craig Silverstein that they were there, and you can always ask them the oral history of Google. Yeah, Rigetti's earnings are going to be bad, which is not going to be good for anyone in the space. I mean, Buffett's got a lot of profit. You know, he doesn't. The more profits he generates, the more float he generates, the more cash he's got, which makes sense. We're looking at Akamai now. He said he's not bearish. I mean, I do think that when you build up cash and you can't find, it's kind of like me. I mean, I can't find great longs. You know, I can find a lot of great shorts. That sort of just basically means I'm bearish too. So Akamai, at least in Q1, was growing at 8%. I think Fastly was growing a little bit faster at that time. It's funny because the gross margins for Akamai are not that different from Fastly's, but they're enough of, they're better, and that's enough for them to be, they're like 5 points better. And that's enough for them to be a lot more profitable and get a lot bigger multiple, because Fastly is only 2 times sales, whereas these guys are closer to 3, maybe 4, 3.5, 4. I think there's something to that. I wouldn't call Akamai the legacy in that case, you know, given they have a lot more revenue and seemingly maybe even more growth and better margins. But again, maybe there's something about the CDN business I don't know. I don't know much about it. And that, you know, they're going to be just fine. That certainly could be the case. Yeah, it looks like growth slowed as well for Akamai, down to 5% at least 2 quarters ago, but probably even more slowing before that. I wonder what people are doing for CDNs. I mean, maybe some companies, I think a lot of companies take it into their own hands. If we want to control how meta is viewed on the internet, we better do it ourselves. I mean, Google on their call talked about their laying fiber under the sea, doing a new project for that. I mean, yeah, just like Akamai, just tons of cash flow. I don't see them buying Fastly or anything. I mean, again, I want to see how, like, what was mentioned is like, are they doing business differently? But even if they are doing business differently, it doesn't look like Akamai is losing anything. Now, could that change over the long run? Maybe. And again, it doesn't mean that just because one company is better than the other, it doesn't mean anything. I mean, maybe with scale, you know, they could be like an Akamai. Yeah, so is Akamai doing like $1 billion in cash flow a year? Maybe not quite $1 billion. Let's see. Akamai could be cheap. I mean, people will always need CDNs. Like, we don't want to set up servers. And I think Amazon, AWS has a product like this. I don't know if it's Route 53 or what exactly, but they have a product like this for CDNs and local. Okay, so here's a little bit better, more current financials. 150 million shares outstanding for Akamai, 12.5 billion market cap. I guess edge compute is a pretty big growth possibility. If you want to put GPUs on the edge, I do think, you know, the best GPU on the edge is the user's GPU. They're more security than delivery now, Akamai. Delivery, they're dropping like a rock. Maybe they are losing share. Co-location fees, bandwidth fees, they really break out their cost of revenue. You're the edge. Still need fast delivery, one way or another. This is a really amazing disclosure here for Akamai. They're super generous in their disclosure. They don't have to tell us any of this. And they have $2 billion of machines out there that, again, they have to constantly refurbish and all that. All right, so 14 billion enterprise value. The revenue was solid, you know, slow and solid growth. There's nothing wrong with that. This is like a normal real business. We look at all kinds of insane businesses. 5% revenue growth. It's nice to look at a real company sometimes. It's the kind of company where the CEO's hair isn't on fire every day. Can you imagine managing like one of these super high growth companies? Oh wait, have you guys been keeping up with Levels.io? For all you guys at home, like what Levels does is very much what you all can do. If you want a quick $1 million, Levels is very talented. But I also think some of his ideas aren't that good either. You could probably, starting today, make $1 million next 12 months, at least on a run rate basis. Levels.io, check him out. That's his name. That's what his mom looked at him and said, "You're Levels." Well, I mean, just look at what he does. He's probably a better programmer than a business person. If you have some business skills, not saying necessarily you learn them from me, but a couple of good business ideas and some focus, I think you could do what he's done. So check him out. Yeah. Shkreli's not going to lead you wrong. Yeah. I've never seen his Lex interview. I tried to buy one of his companies. This is a hilarious story, guys. So nobody knows the story. Not even he knows the story. So I DM him, right? I give him a phone number and he goes, oh my God, I'm a huge fan. I can't believe you're DMing me. I'm like, yeah, great. Here's my number. I need to talk to you. I want to talk to you. Give me a phone call. And I want to buy one of his businesses. Pay cash for it. He doesn't know this. And he goes, sorry, I can't call. I go, what? And he goes, yeah, just waste too much time. I have to build. I'm like, all right, bro. I'm not trying to waste your time. I'm not trying to waste my time. I unfollowed him after that. Yeah, nobody knows that story. I mean, I probably shouldn't take it personally. I may be a rookie. You could take a phone call. You just have to, what you have to do is just keep it to like 5 minutes. So like, no matter what happens, just be like, oh, hey, I gotta go. My dog's barking. It's not a big part of making money, but if somebody wants to talk to you, so what can I do for you? And if they say, oh, I just wanted to chat about, and they say, then you say, listen, I'd love to. I'm in the middle of writing this thing. I need to get done by midnight. So let me set up a time to call you later. And then you just never set up a time. That's the polite way to do it. It's not that big of a deal. So Akamai's cheap, man. 14 times. Yeah, we could look at Cloudflare after this. Security grew 16% for them. That's not bad. It's delivery that worries me. But compute also grew pretty healthy. But yeah, CDN has been dropping like a rock. I wonder if that's just margin compression in this business, because it's like anybody can do it. AWS can do it. You can do it yourself. But yeah, security and computer. It's interesting because you look at the company and you say, okay, well, steady growth, but underneath the hood, you actually see a bunch of tumult where delivery is dropping like a rock, but security and computer growing to offset it. So it's actually not as calm waters as it may seem, just growing 5% a year. I'm going to take a deeper dive in Akamai because it's so interesting. And we're going to look at some metrics we usually don't look at. So I think you guys will enjoy this. The key is looking at property, plant, and equipment. I mean, this is, sometimes I say PP&E, property, plant, and equipment, is the heart of business. And you can't really understand business without understanding what property, plant, and equipment is and why it's so important. So as you guys may know, PP&E is any, PP&E is any purchase of equipment. It doesn't have to be equipment, by the way. Basically anything that lasts, that where its useful life, meaning how much time will it take for you to fully use it, is more than 1 year. A desktop computer is actually PP&E. So there's a lot of PP&E in there that's like not kind of what you think it is. But like obviously a huge machine, I don't know, extreme ultraviolet machine or something would be PP&E, or just a huge drill, that industrial sized drill that's $1 million or, something like that. So that's what PP&E is. And so a lot of the metrics in finance are related to PP&E one way or another, or sometimes people just call it capital or capital equipment. There's a lot of ways to sort of describe it, and we'll go through that in a minute. So they have a $10 billion in assets, but goodwill is like $4 billion. So the tangible assets are $6.5 billion. Okay? And it's a $14 billion market cap. Now, assets are meant to create cash flow, but if you think about it, if you shut down the company today, you'd have $6.5 billion of stuff. Whether or not you could turn it into $6.5 billion of cash is another concept. The lease right of use, for example, is kind of a wishy-washy asset, and it's a new concept for accounting standards. It used to not have to put in leases, and that sort of changed accounting in a lot of ways that a lot of people don't like, but it's not a huge impact either way. You do have a bunch of debt with this company, So it's not like you would get a pile of cash for shutting it down. The reason people are willing to pay so much for it is because it's an earnings gusher. It just makes tons of cash. Yeah, IFRS changed because of this too. So RM Trade knows. So Akamai spent $2 billion at some point on equipment. They have $2 billion of boxes. From this, they make $1 billion a year in cash. Think about how great that is. That is a, wonderful return. That's a 50% return. Imagine you said, oh, well, I can come up with $2 billion. And if I come up, let's say, it does, maybe not you or me, but Ken Griffin could say, well, I'll come up with $2 billion. Would he make $1 billion? And he'd have all the same machines that Akamai would have. And of course, there's a reason they have $4 billion of revenue. They have relationships, they have sales and marketing, they have a brand name, all that stuff. So, it's not that easy. But fundamentally, you could actually create, just think about this in your mind, a carbon copy of Akamai with $2 billion. You could copy and paste it. Now, it would take years to sort of build it up to the business that they built it up to, but you wouldn't have a fundamentally different business. And I think that's the sort of the heart of things, because if your yield, you can think of it as a yield almost, and people will do different returns, but there's this idea of return on equity, and so equity is shareholders' equity, and so in this case it's 23%. You could do return on tangible equity, which is our return, which is free cash flow, and we're going to divide that by shareholders' equity minus the goodwill. You can do return on assets, same sort of calculation. And then you can do return on tangible assets minus the goodwill. So whichever metric you use, you sort of ask yourself, well, if they can get a 50% return, that's sort of, there's one called the Buffett return, which is my favorite. And this is something that is hidden away in a book that is like basically out of print. But Buffett disclosed his sort of favored metric for return. And I have it written somewhere, I just don't want to mess it up. The Buffett return is inventory, which this company does not have, plus fixed assets. So this is sort of what I was talking about, which is a 57% return. I think that, it doesn't matter that much which return you use. I think the Buffett return crystallizes it pretty well. You may also want to add in accounts receivable because ultimately AR is capital that you've put out, basically. You may even want to add prepaids. I don't think you want to add the longer term stuff. So in any event, here's a company make a 57% yield. It's good and it's bad. It's such a high yield that AWS might say, hold on a second, I can buy some boxes. We have distribution. There's nothing that's stopping me from making a 57% return. That sounds great. Because keep in mind that to keep this up versus the depreciation, they have to put in another $390 every year. That's their capital expenditures. So maybe you want to add that too, because you are depreciating this number, but you're also expensing it in depreciation and free cash flow. No, you're adding it back. So I think it's okay to look at free cash flow, because otherwise if you expense capital expenditures, you're expensing it twice. So it's already coming out of free cash flow. So I think that's fine. But you do have to maintain that by spending capital expenditure. But that's not a big deal because we are doing it this way. So anyway, think about it this way. This property, plant, and equipment is a one-time purchase. Okay? So you have $2 billion, but this $2 billion is giving you $1 billion every year. Like imagine a 50% return hedge fund or something. You spend $2 billion once. I clean up $1 billion this year, $1 billion next year, $1 billion next year, $1 billion maybe in perpetuity. Well, it's your job to model, is it in perpetuity or not? But from a business owner perspective, this is like the greatest thing ever. From a stock market perspective, the stock is just what people are willing to pay for it. And they're willing to pay 14 times earnings for it, 14 times cash flow, EV to free cash flow. For a non-grower and arguably business in tumult, that doesn't sound too cheap and it doesn't sound too expensive. I'm sort of attracted to it because 14 times is hard. It's kind of hard to get in most markets, but in a downturn market, maybe that's 10 times. And then the question is if they can ever grow again, and it's not a business under siege, if they can ever grow again, it'd be a really, really big gainer. You probably double your money if they're ever going to grow again. And that depends on your assessment of management. Are they good? Are they not so smart? You got to make up your mind on that.